Welcome back to Indianomics. We have been discussing two separate pieces of rules brought in by the Reserve Bank over the last 1 month to make infrastructure financing easier. Mr. Bansal, the Chairman and Managing Director of Oriental Bank of Commerce, and Mr. Divakar Gupta, the former Managing Director of SBI, were telling us that they expect this to be availed of by infrastructure companies. We are joined by Mr. Madhu Terdal, who heads finance at the GMR Group. Mr. Terdal, you already have a lot of projects, in many of which commercial production has begun. Do you think it will be very attractive for you to go for takeout financing and thereby increase the repayment period for these projects?
Absolutely. I think for an infrastructure company like ours, this will be definitely a blessing in really come in time. And I think companies like us, where we have got a lot of projects which are actually achieved COD, and they are definitely having stress of liquidity. For account of variety of reasons, for account of either the cost overrun or the time overrun, definitely they are under stress. So a repayment schedule of a longer time, say around 20 years or 22 years, depending upon what is the life of the asset. For example, all our energy projects, they are all getting to 25 years. So I think this will be...
know that this will not be available for those of your projects where date of commencement has not been achieved, or commercial production has not been achieved by the plant. Those will not be refinanced through takeout financing.
Indeed, that will be one of our requests, and I understand that is also being addressed separately. I do not know to what extent.
But if that is not addressed, even then, because of the relief you are getting in projects where commercial production has begun, do you think you will have a little more money, since you will, for those older projects, you will get smaller installments over a longer period? Do you get enough financial relief to complete projects where commercial production has not been achieved?
I do not know whether it will be enough or not. One has to have to really take out a case and discuss with the banks, because what is intended in the circular and to what extent actually banks will really implement is an issue. Now,
why do you fear they won't implement?
Because they have to be now, this is not provided. I do not know whether this 525 rule is applicable under this.
No, it is not applicable
it is not
for existing projects.
So if that is not applicable, so then obviously it will be a only one-time facility given to the banks.
No, the 525 is for new projects.
It is not.
What I'm asking you is that takeout financing is available for existing projects where commercial production has begun.
Correct.
So won't you have a project where you started commercial production in 2010 or 2011? There you could go to your consortium of bankers and tell them to refinance it over a longer period. Won't that give you financial relief?
Let us look at some of the reasons why this is needed. Then I think we can debate now. Why these are under stress? Number one, the interest rates themselves are quite high. So first of all, we have to look into what is the approach banks are taking, number one. Number two is, because of this, there will be a cost overrun, or most of the cases they must have suffered a bit of a cost overrun. Now, thirdly, what is the kind of additional equity requirement banks are likely to ask or may not ask? So these are the issues that will finally determine to what extent the money will be available and what is the relief. My suggestion is this should also be accompanied by a long moratorium, apart from the...
No, that is a different issue. We cannot include new provisions because we don't know if RBI will agree to them. But Mr. Bansal, exactly the issues which Mr. Terdal is raising, do you think these will be impediments to refinance, and do you think a moratorium can be included? In that case, will it even qualify for the takeout financing which RBI is allowing?
See, the question of moratorium doesn't arise because now the COD has been achieved, number one. Number two, the relief will be straight away available, because in the initial stage, because of the ALM issues, we have been funding these projects only from, say, 12 to 15 years, while the economic life of an asset, even at that time, we accepted and we presume that it will be 25 years. In road projects, straight away it is given that the concessionaire will be available, the concession period will be for 20 year or 25 year or 30 year. So to that extent, we can extend the repayment period. Naturally, the installment pressure will come down, and to that extent, the money, whatever is available, that can be used for completing the remaining projects, which will be used as a equity.
Yeah.
So I think it's a win-win situation for the bank.
Yeah, Mr. Bansal, will you therefore also reduce the interest rates? Will there be any scope? And secondly, will you require greater equity from the promoters, especially if they tell you that there has been a cost overrun and therefore they want a bigger loan, or will those will not be entertained?
See, it depends on case to case. See, reduction of rate of interest will naturally be considered because the risk has gone. During the construction period, the risk is huge. So to that extent, risk has gone. Now the project has started yielding cash flows. So the banks will be in a position to consider reduction in interest rate on case-to-case basis, depending upon the promoter and his credibility in the market. As far as allowing more equity, expecting more equity and asking for more skin, this is again case to case. But by and large, nothing was available. Banks were scared that a large number of projects which were we started financing in say 2004 to 2007, and then either the COD is not achieved or COD is already extended under the various dispensation available, because once COD is not achieved, then you can restructure the asset without inviting the NPA recognition norms for 2-year period if the circumstances are beyond the control of the promoter. So all these things will be resolved, and Reserve Bank of India has taken a very good step to give relief to the banker as well as to the promoter.
Okay. So my sense is yes, Mr.
I fully agree with Bansal, because Reserve Bank is not really concerned about whether you will reduce the interest rate or you will give moratorium. This will be basically depending upon the bank's own decision and credit decision. So I fully agree with that. That's why I said to what extent benefit will be available will be depending upon the credit worthiness of the client as well as the bankers.
But in any which way it is going to be beneficial.
Absolutely, absolutely. There is no doubt about
it. At least it is a given that you are going to get more installments, and as Mr. Bansal says, it is almost a given that you will get lower interest rates because the risk period is over.
Exactly correct.
Okay,
absolutely
so to that extent you expect a lot of projects to avail of this.
No doubt about it.
Okay, Mr. Gupta, you were raising the point that the very appetite for infrastructure loans is not there, and therefore you were wondering who will take out. Now the point is 75% of the existing lenders themselves can do it, and you know, after all, we know that it is the same set of banks who are involved. Most of them, out of the 30 banks, 20 of them or 25 of them will be involved in every loan. So will it not stand to reason that everyone will want to you know, contribute to this, because you expect the other banker to be cooperative in another loan? So do you think there will be hesitation at all? Bankers should be willing, shouldn't they?
No, Latha, these things can be argued both ways. Which way they will pan out, time has to tell.
But now, you expect resistance from bankers?
No, it's not a question of resistance. So what are the issues? You know, it's right that the project has been closed out, and there, to that extent the risk has gone down. Now who is looking for that takeout? A person who is in stress and who wants relief. If there's a project which is going on fine and everything is great, they can have a competitive advantage out of a takeout, but it's not required for them to...
No, it is not required for that project.
The project for which it is required, you will not get lower rates of interest because the project is still stressed.
I completely agree. What I am saying is that for a standard asset, for which you are not stressed, you are going to get more relief. In the sense, you will get lower interest rates, which is always welcome. You will get a longer repayment period, always welcome. So if your interest outgo on project A was 10 crore, it will now fall to maybe 8 crore or maybe 7 crore. And the 3 crore you save, you can use better on your stressed asset.
Hopefully, but these are SPVs. It's not that fungible that you take profits out of one SPV and put into another. If there is an equity requirement, maybe that can be mitigated. To that extent, the promoter will have a surplus. But otherwise, it is not a given in infrastructure that a surplus of one will go to mitigate the shortfall in the other. That is one point. The second point is the takeout has to be by new lenders.
Yes.
So actually,
only
that is the reason.
25% by new lenders.
No, 25% of the total exposure must be taken out, and the takeout has to be by people other than the consortium. And that is why this 50 has been reduced to 25, one of the reasons. So you have to find lenders outside of the existing consortium who will take this out. If this is a large project, that itself is a challenge. So, you know, if we are going by the spirit
of bankers who are faced with these stressed projects,
right,
and you have to find only 1/4 more.
And those one-fourth have to be willing to take out a stressed project. Because typically for those one-fourth or for a client who is scouting for a new banker, the perception could well be that here are 75% stressed bankers who want relief at my expense. So we don't know how that is going to pan out, you know.
I thought there could be a quid pro quo, because all banks today are faced with one project or the other where they want to, you know, give relief to the...
But experience has shown that that's not the way it works. You know, the biggest pitfall in consortia on multiple lending is that bankers never come to a consensus. They don't come to a consensus in good times because they are undercutting each other for business. They don't come to a consensus in bad times because everybody is fearful that he will be compromising his position. That is the reality. And that brings me to my other pet point on which, you know, I headed that committee on how consortia could function better. You need in India a rigorous consortium mechanism where one lender actually is the interface and sharing is transparent and equitable amongst the others. There has to be a smaller group of lenders which will decide on behalf of all the consortium members, and that has to be mandatory or binding. As long as Reserve Bank keeps on saying that no, this is a freedom we had given and we don't want to roll it back, I would counter argue that today we are not yet prepared for that freedom, and overwhelming evidence has
out of time, sir. Just 1 minute more for Mr. Tedal and Mr. Bansal. How much do you think this will give you relief?
No, the other way of looking at it is, at least when the banks were willing to finance, earlier there was no platform available to them finance. So today, to that extent, I think this is welcome, because there are some banks, from my experience, normally what used to happen, these FIG 5, 6 or 7 banks, they have never participated in consortium all at it together. Where one big bank is there, other two banks are mixed. So my feeling is, if there is a platform which is acting as an enabler, these banks will be able to do a sort of a sharing in their own kind of understanding. I don't say exactly a quid pro quo, but they will be able to accommodate as many people as possible, provided the borrower is a creditworthy client.
Okay. Mr. Bansal, do you think that we are going to see a reasonable amount of relief for the infra owners, and therefore, you know, less stressed assets in the future because the infra project guys have a little more money?
Yeah, I am a positive banker. See, I am hopeful that a lot of relief will come to the promoter, but ultimately it depends on the credibility of the promoter. Now, if he is in a position to complete, say, out of 5 projects in hand, 3 projects have already achieved COD, then remaining 2 projects he will be in a position to sail through comfortably, because the existing 3 projects where COD have been achieved, he will get a lot of relief. And I think this movement of money from one account to another or one SPV to other, all these issues can be resolved. This will not be a major problem, because ultimately the main promoter, when you calculate his total liability towards the banking sector, then you look at the overall promoter's liability towards the sector, and then how much is the stress. So it will be good for the banking, it will be good for the promoter. But the only thing is, we need to sit together, we need to work out the methodologies, and I believe that maybe in another 3 to 6 months' time, a lot of activity will be there on the ground.
All right. On that optimistic note, let's conclude this conversation. The key takeaway from our bankers and from the infrastructure project owner is that there is substantial amount of relief that will come for good projects, which will give the project owner hopefully some relief to put in money in projects where commercial production has not started. On that positive note, thank you very much for watching this edition of Indianomics.